Welcome to the Probus Pleion Outlook 2026. I am Mark Staudenmann, partner at Probus Pleion, and it's a privilege to be your host. Thank you, dear audience, for joining us. In 2025, we've seen a strong year across markets and asset classes. Geopolitics, however, are challenging. In the US, the gap between those that benefit from the actions of the Trump administration and the majority is widening. Consumer sentiment, therefore, has come down. Europe has performed strongly when you look at markets, but will the economy actually follow? And how about emerging markets? Will they benefit from the weaker US dollar? Talking about currency, will we see yet another very weak dollar year? And then what happens to gold, silver, and the other metals? Why are cryptos slumping? And finally, how will interest rates behave in 2026? Dear audience, will try to answer as many of your questions as possible. In order to do so, however, we need your help. Please use the chat function so that we can assure to address your most burning issues. We're delighted to present three exceptional speakers today. Initially, our very own CIO, Adrian Kirigin, will take you on a deep dive into his world, reviewing charts, debating the most pressing points, and see how we look at the markets and the asset classes. Thereafter, I have a privilege to have a conversation with Marcel Schneider, the former CIO of LGT Capital. We'll talk about music royalties and how his strategy has made 10% on average with very little volatility and practically no correlation to other assets. We will finish off with a presentation by Daniel Blasi of Bank Vontobel. He will dissect the opportunities and threats of AI. We want to know if this is a bubble, and we want to understand what risks and opportunities the current situation has created. You can tell with those speakers and topics, we're going to need a bit more than the usual 60 minutes. Whilst we'll deliver as concisely as possible, please bear with us for maybe an hour and 20 minutes or so. Thanks a lot for staying on. Before we start, I need to cover a few technical points. As we will discuss markets, asset classes, and the music strategy in particular, then followed with a deep dive in AI, we have to make sure that this is not intended as investment recommendations. We'll never present to a broad audience what you should or should not do. For that, please contact your client advisor, contact myself, and we'll give you something that fits your needs and make sure that this complies with both the regulation in your location as well as with ours here in Switzerland. So, besides that, we obviously need to make sure that all the regulations are, in check and done. But we'll see if Adrian Kirigin is actually out of his prior meeting. I think, Adrian, you're here, right?
Yes, Mark, I'm here.
Fantastic. Adrian, it's fantastic to have you. I know you have a very busy day. Thanks for joining us. I don't want to make it longer. The floor is yours.
Thank you, Mark. And thank you, ladies and gentlemen, for joining us for this quarterly market update. I will share my screen so that we can begin. Mark, if you could confirm that you can see it well.
We can see it.
Okay, thank you. All right. So the objective of this section is obviously trying to answer all the questions that Mark has listed earlier. A very daunting task, of course. We'll begin by having a look at the various major economies, the monetary and fiscal policies that are in place and likely to be in place in the future, and more importantly, the implications that that all of this has for the various asset classes. So, we've been of the opinion that the US economy would sort of hold up, right? That there would be some minor disappointments, but that the economy would be okay, and that there were fairly good odds that the economy would potentially improve later in the late in 2025 and early 2026. The issue is that, of course, we've had the longest government shutdown in US history. This has meant that fewer data points were published, and therefore it was a bit harder to sort of assess the current state of the economy. This is now being resolved with data being progressively released, but there are a number of sort of alternative data sources, private market data or private sector data sources that have sort of given us confidence in that view. So one of the key elements is, of course, consumption, right? And consumption has held up so far this year, despite the fact that obviously tariffs have been in place, right? Tariffs now represent over 1% of US GDP, and they are, as the chart here on the left shows, largely affecting the poorest parts of the population. You can see here that the bottom first and second deciles are clearly the ones that have the biggest impact on their income, given the level of tariffs. Now, despite this facts, consumption has held up because, and this is something we've already highlighted in the past, around 50% of US consumption is achieved by the top 10% of the population. So, and to a large extent, the consumption of this top 10% of the population depends on asset markets. You can see here first, maybe at the bottom part of this chart, that equity allocations for US household is at a record high. That means that as long as equity and asset prices hold up, this segment of the US population is doing very well. You can see as well that the household net worth overall in the US, and this is only in Q2, increased by 7 trillion, not counting Q3. And of course, this is directly feeding into the comfort to spend and therefore consumption and economic resilience. Now, this has resulted, as our friends at Hedgeye show, in a very K-shaped economy, right? The top part of the K is doing well, the bottom part is suffering. This has, of course, implications for policies that might be implemented in 2026, as we'll see in a bit, because Trump's approval ratings have wobbled, to say the least, in the past few months. Now, another key support for the US economy has been the amount of capex done by the large US tech companies that represents significant investments that has supported economic activity. Here, this graph is basically showing that on average over 2 quarters, it has represented about 1.1% of US GDP growth. 1.1% of the out of the let's say around 2%, 1.6 to 2% GDP growth. This is an enormous contribution. You can see that it is the level that we've seen prior to the dot-com top in the late 1990s. So this has been a sort of a virtuous circle, right? Because you've had significant capex from tech companies that has supported the economy and equity markets, which has supported consumption from the top households, which has supported growth. This has been sort of a classic reflexive loop, in the sort of Soros terminology. It has been constructive. The only issue is, of course, that this could turn into a vicious circle should the capex investment start to roll over or be revised down. This is a key factor, therefore, that the link between financial assets and the economy has never been greater, and makes the following the AI thematic very important early into next year. Now, on the labor market, which has been also a source of concern, we haven't had the payrolls data, which is the number of jobs being created for October. They won't be released. We will have them for November this week. Payrolls have clearly been on a sort of decelerating path, which is what you see at the top part of this graph, right? They've rebounded in September, but they've been sort of easing. It's very likely this is reflective of a new equilibrium, right, in the labor market. But there has been signs of moderation. So from what we see in various leading indicators, it's likely we continue to see moderation, but doesn't look like there's going to be a significant weakening on the labor market front, in our view. Again, with data being released this week, that might sort of help to sort of confirm or infirm this view. An important factor, however, that sort of ties up with the AI developments is that there is a prospect for sort of this sort of K-shaped economy we discussed earlier, is also reflected in the fact that there's a lot of youth unemployment. You can see the dark line in the top part of this chart that youth unemployment has risen and sort of created a quite a significant gap with the overall unemployment rate, right? The unemployment rate being around 4.4 and the youth unemployment rate around 9.2. This is possibly a reflection of how disruptive AI has become. And as you know, obviously, entry-level jobs are more easily replaced by the current sort of technological revolution. Something that is very important for sort of societal stability, and that might imply some sort of measures being announced in the US. So in the US, we know already that Trump has announced or managed to put through Congress the Big Beautiful Bill. This bill will lead to expansionary fiscal policies, right, in 2026. That means that it will support at least certain segments of the economy. The issue, of course, is that, for example, tax cuts will mostly accrue to the richest part of the population. On the other hand, we have tariffs that are impacting the poorest part of the population. And this is largely explains, in our view, how Trump's approval ratings, which is basically this chart, and you can see that it has sort of eroded throughout the year. These approval ratings have gone down. And the question, of course, for next year is what is Trump's administration willing to do in the run-up to the midterms to push them back up, right? There are some headlines that have already been circulated. You can see here, Trump considering a $2,000 dividend to Americans using tariff income. The point is that the incentives continue to suggest that the U.S. administration will use the levers they have, which is fiscal policy and monetary policy, to support the economy and to potentially give a little bit of benefits as well to the lower part of the population. So on the side of the US economy, the conclusion is that we expect it to hold. We potentially see some improvements into the early this year and early next year, and we think that to a large extent it will depend on what government policies are going to be implemented. Now, looking at the other major economic bloc, the European Union, we continue to have the same view we've expressed in the last 2 quarters, and the major shift here is that the German constitution has been changed, allowing for more fiscal spending, a dynamic that has not been in place for decades. And of course, this is a continued cyclical support for not only the German economy, but also the European economy, because it leads to more tolerance for other countries' fiscal spending. And you can see here that there's a coordinated increase in government capital formation, so of infrastructure investments, as we know, a significant infrastructure package having been announced in Germany. This continues to sort of support our cyclical positive view of Europe that we've held throughout the year, and we've seen no reason to change. Now, the European economy has been largely supported by in the last few months by the services industry, surprisingly. But we see that because of all this structural or this infrastructure spending, we think, and there are a number of leading indicators that we follow, we think that also the manufacturing side of the economy is going to see some improvements going forward. Another factor that continues to be supportive is that the amount of credit growth, so loans being granted by commercial banks in Europe, as you can see here with the top part of this chart, continues to sort of improve. This has been, of course, triggered by the ECB cutting cycle, as you can see here at the bottom of this chart, with rates being cut over the past couple of years, I'd say. And this continues to sort of feed through to the economy, which is also why, as we'll see when we look at equity markets, financials have done extremely well. And we think that this dynamic could continue. Now, moving on to the other major developed economy, Japan. What are we seeing there? We're seeing a new prime minister, Takaishi. What is she putting on the table? She's sort of reviving the Abe playbook, which is supportive monetary policy and fiscal expansion. Again, with this type of policies, it's very hard for the economy to go through a slowdown, and therefore this has implications for the economy, mostly in nominal terms, but of course it has also an impact on inflation. For example, it is quite surprising that if you look at, let's just focus at the top part of this chart, you can see that Japanese CPI inflation remains around 3%. And despite that, they're running a monetary policy that's quite easy with rates at 0.5. Yes, they will most likely hike them this week, but they remain behind the curve. And they, despite that, consider to use fiscal policy. So again, you can sense the thematic, right? The major economic blocs are increasingly using the fiscal lever to support their economy. So now, the biggest problem, of course, is that they're doing that when inflation remains elevated, right? You can see in the US, we have CPI that's around 3%. In Europe, it has come, sort of stabilized around 2%, but it remains sticky and elevated. Now, we don't see inflation in the US necessarily accelerating in Q1 unless there is a significant energy price increase, which cannot be ruled out. But later in 2026, there could be rising inflationary pressures, and the message here is that central banks' focus on inflation has clearly weakened. Right, they are more tolerant of having higher inflation. Now, in terms of what these central banks will do, we don't need to look at the details, but the point is that on the left part of this chart, you can see that these lines, which are the central bank rates, have been cut in 2025 and 2024 quite aggressively, right? The only, obviously, central bank that hasn't cut but has increased rates is the BOJ, the Bank of Japan, which is now set to increase it a bit more. Now, in 2026, if we look at what markets are anticipating, and this is the right part of the slide, you can see that the Fed is still expected to cut by about just below 0.6%. Which is this light blue line. And if you look at the top part of this chart, you see that other central banks are either expected to basically stay on hold, such as the ECB or the Swiss National Bank, and some that are considering to, that there's a possibility that they might hike. The point is that we have gone from an environment where all central banks were going in the same direction to one where there might be divergences. And the Fed stands out as one that will lean on the sort of more dovish side, so more accommodative monetary policy. Now, as we know, the Fed chair is up for replacement. Say a new Fed chair will be put in place in May, and the Trump administration has discretion over who it will be. It's interesting to see that we've known who the candidates are for a while. It's interesting to see how betting markets, which, as you might know, have really increased in popularity and reliability over the past few years. They are sort of pricing these these probabilities have converged even further. So you can see the probability of Kevin Hassett and Kevin Warsh. It's basically now coin toss, right? So we're waiting to see who Trump will sort of nominate as the new Fed chair. We all know what Trump wants. He even said it last week again. He wants rates at 1%. Now, of course, this could have significant ramifications, right? He could actually see the long-term part of the yield curve go up. There are significant dangers here. So the point is that we think that the central bank will err on the dovish side. They will be too dovish relative to the underlying conditions, which is of course very important. You also know that recently the Fed has announced that they would start expanding the size of their balance sheets again, by buying some treasury bills. So all of these elements continue to point in the direction that both on the fiscal and the monetary side, the institutions responsible for them will be more supportive, right, or remain supportive. And the reason for this in the US really is quite clear, right? You can see interest expense crossing, $1.1 trillion in percent of GDP. It's at 3.8%, and this is a clear way for them to reduce, the deficit in a way by bringing interest rates down. Of course, it is depending on how they do it. It could be misguided, but this is why they are likely to stay on this sort of easy side. Now, so far, what we've established is that on the economic side, major economies, and we'll look at China in a bit briefly, but major economies are trying to support, major governments are trying to support their economies, right? They're seeing fiscal policy that should remain supportive and monetary policy that also will remain slightly, too accommodative relative to the conditions. And now let's look at what markets have done. And do they echo or are they in line with what we're seeing, right? So what do we see here? We see the performance of the major asset classes, right? We can see gold at the top of the panel, up 60% this year, even more now. You can see that we have the MSCI World ex-USA, which is up 29%. So first signal, you have international equities that have maintained their outperformance over US equities, which as you can see here is up 18%. And then we see that commodities are up 11%, whereas the global bonds index is up about 7.4. So this first shows that the reality is that if you measure equities not in their own respective currencies, but in gold terms, they haven't really gone up, right? So there's been a lot of discussion about the debasement trade, and this is a good illustration of it. Basically, governments are, in a way, by continuing to expand deficits and debts, they are diluting the value of their currencies. On the other hand, we see that commodities have firmed up and done quite well, despite energy prices being quite weak, which is an indication that inflation is likely to remain sticky. And this is indeed what we see. And on the bond side, they've been okay because inflation has not gone off the charts. There's been some growth concerns, but they've been the underperformers. And we continue to see that happening. The dollar is, of course, key. In the previous quarter, we had a moderately bullish dollar view as quite temporary. We continue to think we're in a dollar bear market. Here, what you see is the dollar index. However, to a large extent, it depends on how many cuts end up being materialized or priced in for next year by the Fed. So we could have a situation if Kevin Warsh, for example, is elected and he pushes back against aggressive cuts, we could see the dollar consolidate a bit longer. It's a possibility, but we think we're getting close to the dollar, taking a next leg down. And of course, that means that given our view that bonds are not going to be very attractive, and that the dollar will remain on the weak side, a very interesting segment, if you look at fixed income, will be emerging market local currency debt, with some potential appreciating pressures for Asian currencies, which we continue to see, and of course, some elevated real rates. Now, in terms of equity, let's look at the major indices a bit more in detail. So Here, the gray bar is showing you the year-to-date performance of these various indices. And the blue bar is showing you the performance in Q4 up to the 12th of December. What we see, first of all, is that indeed the major, the best performers have been, Europe, China, interestingly, the Swiss market index, thanks to the currency, and the topics. And then you see the other sort of US indices that have done okay, but they are trailing. Then in Q4, we can see that this dynamic has been maintained for most of these indices. Europe has done okay, the Swiss market has done well, the topics as well. But China is the one that has sort of lagged in the past quarter. And as we'll see, it is possible that it extends a bit further into Q1. Looking at the earnings growth expectations for next year for these various markets, what we see first, as you can see with these various bars, if you look at the gray and blue bars, they're basically showing you the expected profit growth for 2026 as of the end of last quarter and as of today. So first, what we're seeing is that earnings growth, profit growth expectations remain quite elevated across the board. Of course, they could be a bit overly optimistic, typically in the US. Probably just like at the beginning of last year, they were expected at 15%. They end up being around 11, but it's consistent with the sort of elevated nominal growth environment we're talking about right now. Interestingly, we see a big pickup in European profit estimates, which would be necessary to sort of also validate the progress we've seen this year. And another important factor is that India's earnings growth estimates are also expected to reaccelerate. India has been quite an underperformer this year. In the US, there are two important elements that we need to sort of mention following the observation that we made earlier, that growth has been largely influenced by the amount of capex from the tech sector. So the US equity market has held up very nicely. It has during most of the year been supported by the tech sector, but there's been an interesting development is that there's been some cracks sort of showing in the AI thematic, right? And we've seen actually other sectors in the past few weeks that have started to participate a bit more into this market. And this is kind of a very fragile sort of dynamic, because we need the other sectors to start to continue to sort of support the market as the economy holds up and potentially improves, especially if the AI thematic is sort of consolidating for a while or starts to underperform, given the weight that they have in the index. Something that might support this view is that you can see that here, the small caps in the US, the Russell, is trying to come out of this range that's been in place for many years, right? We'll see whether it holds into the end of the year, etc. But this is a positive development that sort of supports the view that maybe other sectors of the market might, sort of lead going forward. If we look at and of course, our guest will delve deep into the AI thematic, but there are a couple of elements that when I mention, the cracks that are appearing in the AI thematic, you can see here a number of factors that are quite well illustrated. So first, we all know, and the market has known, that the amount of capex that these elevated, these tech companies have been doing this year and announcing for the coming years is astronomical, right? Yes, they have very solid balance sheets. Yes, they have very strong cash flow, but they've been sort of using more and more of this cash flow to finance this potential for future gains through the AI thematic. You can see in the bottom part of this slide, this sort of the amount of capex relative to revenues for some of these large tech names are, at the level, or for some higher than the amount of capex a utility needs to put in place or to spend, right? Or a telecom company. And there's been so far the market had been quite tolerant, but there's been a few signs in Q4. Typically, Meta, has announced increased capex, and the stock was punished. Oracle, who was initially rewarded for its partnership with OpenAI, got then all the gains fizzled out very quickly. And so it's very important because the market might be finally telling us that the tolerance for this excessive spending is maybe declining. In which case, and then you've had, of course, Alphabet putting into question the supremacy of NVIDIA by launching their own chips. So all of these factors mean that we might see this sector sort of consolidate for a while to see, where the chips fall. In Europe, just briefly on the equity side, you can see that year to date, again with the same sort of illustration, that financials, utilities, industrials, energy, they have all been the best performing sectors year to date, right? However, in Q4, the industrials have underperformed. We continue to favor both financials and industrials. We think that the industrials sort of profit and earnings prospects for the coming year remain very solid. They've consolidated a bit their sort of advance. We think that this still is very reasonable to keep exposure there because of all of this government spending that's being put in place and actually being spent into the economy in the coming 2 quarters, right? Quick connection with China, where we have been bullish throughout the year, as some of you may have followed. But recently, what we've seen is that data has sort of underwhelmed. And you see it across the board. You see it across retail sales. You see it across industrial production. It has underwhelmed. And you also see it in the real estate sector that had started to pick up a bit. Well, you see that, residential sales have rolled over. You see that, prices also are sort of weakening a bit. So we think that the government remains very committed to supporting the economy. They've reiterated the importance of supporting domestic consumption, domestic demand next year. And they have a situation here where they have, and the Chinese trade surplus has exceeded $1 trillion. So, the Chinese economy is largely currently holding up also because of the amount of exports that they are conducting. And the government continues to want to rebalance the economy a bit more towards domestic consumption. And yes, in the coming quarter, we expect that additional measures will be put in place. The issue is that they might not come in the next 2, 3, 4 weeks. And therefore, what we're seeing now with China, which is basically the markets consolidating this, as you can see here with the Shanghai composite, the market is sort of consolidating this big advance. We think it could, this consolidation could extend. It could be a bit more downside in the short term, but we're on the lookout for a catalyst. It could be, Alibaba announcing its the new version of its sort of ChatGPT competitor. Could be government measures. On the lookout for this. In the meantime, it's worth to sort of stay a little bit on the back foot for this market, in our view. On the gold side, precious metals have been a key investment for us this year. Obviously, gold is in a historic bull market, right? And it is happening because there's incremental realization from Western investors that bonds are not fulfilling the role they used to fulfill in portfolios. They cannot fulfill the role they used to fulfill because governments are increasingly using fiscal policy and monetary policy to support the economy at the expense of bondholders, as the purchasing power of the currency is being eroded. So, the question is when gold has gone too far. And we actually tactically reduced a bit our equity exposure in the spike because there was a lot of retail speculation. But if you look at global allocations, they remain quite reasonable. So, gold is basically moving in acceleration phases and then consolidation phases. It might be in one of them. We think that a next leg up is on the cards in the coming months, and we're on lookout for it. Other precious metals have actually outshone gold, silver up 110%, and platinum group metals like palladium, platinum also performing very well And for those, we still think there is some upside, right? Now, on the commodity side, which, as I showed earlier, have done relatively well, it's important to notice that this asset class has done well despite energy prices being very weak. And we think this is a very important thing to keep in mind for next year, is that there is a prospect for energy prices to start to wake up. So currently they're trading very poorly. So if we need to think about what has happened, right? This year we had OPEC production going up 2 million barrels, right? And at the same time, US production also increasing moderately. Recently, we've seen OPEC announcing that production increases are not on the table anymore. And there is increasing sign that U.S. oil production could start to top out and potentially come down a bit. Of course, now we have a lot of headlines around the resolution of Russia and Ukraine war. It's keeping a lid on oil prices, but we think into Q1 we need to be on the lookout for this excessive bearishness on the energy side to sort of disappear. And we see that it could be some significant upside there in a segment of the market that is very cheap, very under-owned, and that remains key to the economy, especially if the economy continues to hold as we expect. Here you can see on the left side this commodity index, the global commodity index, that is very important because as much as we can, we try to sort of heed the messages that markets are giving us, right? And what you see is that commodities have sort of been in a range for the last 2 years, and they are attempting to come out of this range. They have already, without the contribution from energy. And mostly it's been industrial metals and precious metals, obviously. And with the prospect of energy prices potentially making a bottom and moving up in 2026, and the importance of commodities in an inflationary environment, we think it's key to retain exposure to this asset class into 2026. There are some very specific cases that we can debate with. We don't need to get into here, but we can discuss directly with you on an individual basis. Typically, the link between the AI thematic and the energy component, because to a great extent, we think it's probably a very interesting way going forward to play the AI thematic through a segment of the market that's under-owned, cheap, and that will see significant increase in demand from a combination of data center energy consumption and increased LNG exports next year, and that would be in the oil and gas, particularly natural gas sector. So there are some very important and interesting opportunities to be discussed if someone would like to. So, of course, this the outlook that we have shared already yesterday and sent out, and that you will receive if you haven't yet, contains much more detail than what has been discussed today on various economies about the Southeast Asian countries, India, etc. Please feel free to look at it and ask questions if you have, if you'd like. Here is a summary of the basically major asset classes and countries. The conclusion, of course, is as discussed, with an economy that holds up in the US, but some wobbles on the AI thematic, we sort of remain neutral US equities. We don't think that's possible. We think that with a nominally high environment, you need to continue favoring equities over bonds, but we prefer international equities rather than US equities, where we would want to not chase the AI thematic, rather look at other cyclical sectors. And you'd prefer to own some European equities, some Japanese equities, a short-term, more moderate stance on China, as you can see here, that we expect to move back to overweight into the quarter when we see some catalysts. And then if you look at the fixed income side, we just don't like duration at all. Still in US and European long-term debt markets, we still prefer to take risk into emerging market debt in local currency terms. And then on the commodity and alternative side, you can see that we continue to remain bullish on precious metals and their miners and on commodities. So again, feel free to ask questions. I'd be delighted to answer them. And Mark, the floor is yours again.
Thank you so much for the summary and the insights, Adrian. Greatly appreciated. Let me reiterate again, please use the chat function in the tool directly if you have specific questions, so that we could answer them as directly as possible. With that, I would now turn to the conversation over to Marcel Schneider. Marcel is the founder of Alternative Partners, specializing in music royalties, and he's a long and very broad experience as a former portfolio manager, turned head multi-asset management, and finally CIO at LGT Capital. In 2015, he left LGT in order to lead the investment management of Bank Reichmuth as their CEO. And he's here today for us. Marcel, thanks a lot for being with us.
Yes, thank you. Hopefully you can hear us or hear me. Is this possible?
We can see you, we can hear you, everything perfect.
Good morning or good afternoon, everybody. Thanks very much for the little introduction, and it's nice to see you here.
Excellent, thank you. Marcel, before we go deep into music royalties, tell us what we need to understand about it. To me, it's a concept that I don't really understand. How do they come into existence? How are they created, and how do you deal with them?
Yeah, okay. Overall, it's not so complicated. Music is overall, and maybe we can show you little slides. I will try to share the screen with you. We prepare something. Just a second.
Sure. Thank you.
Does this work?
Yes, it looks good. Yes, perfect.
Very good.
Maybe you can go into full presentation mode, and then it will be even more impressive.
Like this?
Yeah, now we're perfectly there. Yes.
Perfect. So I think overall it was helpful for me to understand, and hopefully for you as well. Very briefly, music rights fall into two main categories. First of all, we have songwriter shares, or we call it composition copyrights. Normally from a songwriter, sometimes he needs some help for lyrics or text, but overall this is then the composition copyright we call this, and I have one category, and the other main one is then the recording of a song. Normally artist, the band, together with a record label. So then the sound recording copyright are born. So these are the main two categories, and obviously they're profiting from any cash flow yields if songs are used in radio, streaming, or selling CDs. It still exists, LPs, whatever, or as well in musicals, in live performing things. Then we have a split going to these two shareholders. It could be that there are much more than two. For example, if a songwriter has a co-songwriter, or it's a group, or the same thing is true if then the artist, the band is split by several individuals. But overall, we have here these two main categories in music.
Understand. I appreciate. So you can basically split these two rights. How long do they last? You know, if I write a song today, how long will I be protected? Or if I sing your song, how will that work out?
Yeah, this is I think one of the really interesting cases or thing in music and in rights like this. Again, here it's a bit different between these two main rights. So normally a songwriter, he has to write for 70 years, but these 70 years only count if the last songwriter's or if the last songwriter's death. So if you have maybe 2 or 3 songwriters, it's then really another 20, 30, 40 years plus 70. That's the normal issue all over the world. With an artist band or the recording copyright, there is a bit different between Europe and the US. normally it counts from the very beginning if the record starts. So if you have a launch of a song in the internet or with a CD, you have then 70 years normally in Europe and around 90 or not around 95 years in the US. So it's important to have an eye on this. So Elvis Presley, for example, or Michael Jackson still has a lot of rights. On the other hand, if you buy Mozart or Beethoven, that's out of this time, and so you have to be careful.
Absolutely. Now, music is everywhere, right? I mean, we go into a shopping center, we take our car, we go to the office. Everywhere there's some background music somehow, but few of us really think of it as an investment market. How large is the market today?
Yeah, I think this is one thing. What is often underestimated is that music is one of the most consumed forms in media globally, and can show this maybe here. There are three main parameters or music income drivers. One is still radio. For example, there exist more than 1,000 US country radio stations. So it's still a huge form, but it's not only US country, it's all over the world. Radio is still alive, even if the earnings are not the biggest one for music owners so far. We have then the live part, could be musicals or concerts, live acts, still important. And I would say that the most dynamic part is really the recorded music one. And it was as well 20 years ago, maybe the weakest part in the music industry. You see here around 30 billion in cash flows yearly is coming in to the right holders only in this recorded music stream. Overall, it's not so easy to tell a detailed number, but it's between 50 and 70 billion yearly cash flow for music holders. So it's quite a huge market. That's the cash flow. That's not the market cap, obviously. And maybe this is now I split this down, recorded music, to show you a bit the dynamics there in the last 20 years. So these red bars were mainly driven by physical sales, LP, CDs. This is really, almost done, 70% down in the last 20 years. But on the other side, we have a new income driver, a very growing universe with the streaming. So from 2010, 2012, we have then the new agreements between the large streaming platforms and the music industry. And now, as you see there, the growing pattern, it's now more than 20 billion earnings only from streaming. And so far, with a look in the future, it's still growing for the next 5 to 10 years. So we have overall here around 60 billion cash flows in the music industry per year.
Wow, that's impressive. When you look at, purchasing into the music industry, purchasing song rights, I believe you call these catalogs, right? Now, what are the key factors that you look at? When I buy an equity, when I buy even a car, I know what I should look for. But in music, what factors are you looking at, and does that fit into a specific strategy that you're running in your framework?
Yeah, here again, thank you for this question. Is really that it's not so different than analyzing equities or analyzing a real estate investment at the end. So the main part or the main thing that you look in the catalog, we call a catalog if, for example, from a songwriter, he's producing 50, 100 songs over the last 20 years. And then we have a cash flow from all of these songs. So first of all, the historical revenue performance and volatility is important. More or less the same if you analyze a share or an equity, a listed company, or if you analyze a real estate as well. Then some growth drivers are important. And then maybe you have some specific patterns, I have here a little chart. What we are looking for in an investment on top of this, let's say, regular pattern. One thing is, we have here another thing, like, for example, in private equity, you have like a J curve. The first 5-10 years in a venture capital, you have normally no earnings. And then after 10, 15, 20 years, the cash flows are coming in. Here, it's more or less the opposite. If a huge song, cool song, a hit is producing by a songwriter or a band, then you have the highest income in the first 2 to 3 years. So then it's in the head for a lot of playlists. A lot of radio stations are performing these songs, or a lot of other bands as well. And that's really, I would say, in 90% of the cases, from year number 2, 3 to year number 7, you have a large decay of these earnings. And with large, I mean, if a song is delivering, let's say, 100,000 a year in year number 2, it's going down to 10,000, more or less, in year number 7. So around 70 to 95% less than in the top years. And that's why we concentrate really for songs, and hopefully evergreen songs, remarkable songs. They are 7 years and older. So we try to avoid these first 7 years. And even better if it's 10 years and older, because then you have some kind of a stability of the cash flows. On the other hand, that's more our strategy. It's still possible. It's a very fragmented market. So you can maybe see that a lot of musicians, a lot of songwriters are owners of the songs. And not everybody is calling ABBA or Taylor Swift. There are some smallers as well. And so the sellers are really private persons, sometimes together with a management or together with a little label. And so we try to invest in off-market transactions. So if possible, not in a bidding process and things like this. And then last but not least, we focus on evergreen songs, remarkable songs that is still famous after 20 or 30 years. Maybe some names that we like is Status Quo, Simple Minds, or even a Michael Jackson, things like that you have great recognitions there. Last but not least, it's a bit like portfolio management in the regular markets. Diversification effects are important, that you do not focus on only 1 or 2 songs, that you have different genres and styles overall. So that's a bit the differentiation to the others.
Thank you, Marcel. That's appreciated. So in short, I could call you a value buyer that buys into stable cash flows, right? If you were to go very early, I become a hit or I may not, meaning that you waste money or you make a lot. But later on, after year 7, you have a reduced but stable cash flow that you're basically willing to bet on and to invest in, right? Now,
absolutely correct. For us, this is the main trigger. There are Universal or Sony or Warner, the huge players. They have sometimes another strategy. They buy as well song rights in a very early stage. We can call it venture capital investment if you want. And then they have the manpower to push their songs in radios, doing musicals. And so you need a lot of manpower to push then new songs. For us, it's really I would say the stable cash flow investment is in the focus.
Fantastic. And then with every asset class, with every, anytime we, apart from $1 of ours, or even if we have $1, we always have risks. In your portfolio, in the way how you manage your own assets, etc., what are the key risks in that strategy?
There are risks in the music industry as well, than in all the other markets, I would say. One of the main risk factors, maybe you underestimate that from from an outside is the currency risk. So obviously, a huge song is global played, and then you have incomes from everywhere, not only US dollars or euro and some Asia currencies. Really, it could be every currency. Like for example, we had some songs with Turkish lira, and the Turkish lira were down by 40% last year. On the other hand, and this is maybe the other risk or chance, you have an inflation protection, really an inflation protection in this asset class. So a high inflation will help you. To do this example again, in Turkey, the inflation were 40% as well last year. So then you have higher inflows on the other hand. So you have some kind of volatility because of currencies and inflation. With a broad diversified portfolio, it's much, much better. So, for example, for us, we do now have a volatility of less than 3% over the last 5 years. This is why we have more than 30,000 songs from almost everywhere. And so then this is really helpful. Other risk factors, now I would say more and more, we have a discussion about AI. So disruptive technologies. And it's true, maybe I could go back a bit, and this is, I think, still interesting to see. We had this 20 years ago as well with streaming. Maybe some of us could recognize or remember that between 2005 and 2010, we have a market that it was possible to download songs for free from the internet, paying nothing anymore for the songs. And then we do need to have a new regulation there. And what is obvious, even if AI platforms are using songs for their technology, they have to pay for it. And we do have now a lot of discussions between the huge labels, the huge platforms, and the new AI technology partners. How much do they have to pay, and what is the regulation behind? So there is, I would say, a risk, but not a risk that is at the end much less income. It's maybe more a new regulation. And what, for example, for us, we are a bit careful with background music or DJ songs that are easier to, let's say, to produce by technology or by AI platforms, but the huge evergreen songs are all more or less profit from this kind of style. So I would say risk are also on the other side as well. Chances, maybe I would say these are the FX, inflation, some technology patterns, and maybe concentration risks if you really invest in let's say only buy Adrian, and then he has an issue in 10 years from now, maybe. So that could be a risk as well, more related to the actor.
Okay, understand. Now, when I put my risk management, portfolio management hat on, one of the points that we have discussed, not this morning, but earlier on, was the counterparty risk, right? Right now, we're a bit concerned in some of the credit markets about counterparty risks. Tell us how this manifests itself in your case.
Yeah, this is, I would say 5 years ago, I would tell you there is almost no counterparty risk in the music industry. I could tell you why. This is a bit how it works. We call this organization normally PROs, public. A lot of them are public or main, so half public. In Switzerland, for example, we have Suiza. They are responsible for collecting the money from the radio stations, from some platforms as well, and then they are paying to the royalty owners. The same thing is true in a lot of other countries. Overall, if a radio station has to pay for a song, that's around $1 to $2, and so we have almost no credit risk in case of a radio station. If this station is not able to pay, or let's say a concert is not able to pay, you lose several dollars, maybe less than that. And this is still possible, but overall, this counterparty risk is really low. Now, and this is why the last 5 years it was a bit changing the industry. We have now some huge players in the market again in the streaming situation. Spotify, for example, they are paying in 2024 around 10 billion, only Spotify. There are some others, Apple iTunes, obviously YouTube, Amazon, these large players. So there is some kind of risk, but we have then the really big players, the big names. So the ASCAP in the US as well, they are paying around 2, 3, 4 billion in a year, but they are as well very safe in this kind. So more or less, it's not a credit market here. It's really safe in this relation, but the hugest players are Spotify and co.
Fantastic, Marcel. Thank you so much for that. Any short closing remark?
Yeah, I would say music is really one of the less. There are not so many asset classes with a cool cash flow yield, and sometimes this is a question that it's still possible to invest in music with around 10 to 12% earnings without any leverage. And if you're comparing this with other alternative classes, it's still interesting. And that's why we think from a multi-asset perspective, it's a very good diversificator and not correlating to the classical asset classes.
Fantastic. Marcel, thank you so much for the explanations and the insights into music industry. That's greatly appreciated. And with that, I would take it back finally to the last highlight of the day. Daniel Bläsi, Senior Investment Advisor at Bank Vontobel here in Zurich, multi-decade equity trader, is here and joins us to discuss AI. Right? We appreciate our partner Vontobel for their high quality research and particularly for covering some of the markets and stocks that are not followed by the very big houses. Daniel, we spoke almost 5 years ago at the very start of the AI hype. Back then, the trend is, from the trend that was starting then, AI has become a massive driver for markets. Where are we today, and how do you see the future?
Well, good morning from my side. Thank you very much for having me here, Mark, and thanks for the invitation. Yes, indeed, we have been emerging tremendously over the last 5 years, and I think the call we did back then was probably spot on. Now we do get a lot of questions. Where are we now? Are we in a bubble? Yes or no? First of all, let me say this is not going to be a tactical call. This is going to be a decade call. And I think that's important to understand these trends we are now seeing in AI. Of course, they are to some kind cyclical, but that doesn't change the big picture, as I just said, talking 5 to 10 or even 15 years. And also thank you to Marcel Schneider. You mentioned a couple of points which I'm more than happy to take up, because whatever is being streamed these days is only available thanks a chip behind that, and that's a chip basically is driving our world. So no chip and no lights in the room and no Zoom call available. Well, shall I just start and kick it off? All right, here we go. So if you have any questions, shall we answer them right away or at the end? Whatever you prefer. So what has really changed is, and I'm a strong believer, we are now in the middle of an industrial revolution, which none of us probably was able to be a part of it while being alive. The striking thing from that slide is basically these industrial revolutions, they took back in the old world much longer to emerge, but the cycle were a bit longer. You can see that. Let's have a look at this steam power rail steel thing. It went probably for 25, 30 years, and it was pretty much flat. While you can see now at the top and right in light blue, how fast these ChatGPT or this technology by definition emerged, it went really quick. But on the other hand, the time span might be a bit shorter than we used to see electric engines, chemical, steam power, etc. Maybe we can go to the next slide. So, okay, where are we now? And that is marked with the red dot number 3. So we're coming from the AI model launch 2 to 3 years ago, actually exactly 3 years ago and a few days. ChatGPT launched it, or OpenAI launched ChatGPT. Now we are in the middle of infrastructure build. That's today, light blue. We probably, I wouldn't say coming to an end of data center building. They now discuss how to build this data center, for instance, in space, but it's a completely different story. So now the question really is where we go from here, and the next step, and that's seen as 1 to 3 years, maybe it's then 1 to 5 years, it's really hard to judge, but we talk about enterprise consumer adoption. So in the sense, co-pilots, enterprise data, workflows, but above all, AI agents and AI assistants. So we have now entered a world where I can have at my desk an employee costing almost nothing in the form of an AI agent. He or she helps me a lot by being more efficient on my daily work. And that help comes almost for free. So I don't need a new headcount. I only need like a subscription model, and I pay $20 a month and have full employee at my desk. And then the next drive will be in 2 to 5 years, AI experts emerge, doctors, lawyers, advisors, and so on. Then we're coming into the automation and robotics. We all see these videos going around on YouTube about humanoids, autonomous system. We are at very early stage, and people tend to laugh about these robotics, how they behave, they fall off, they get up again. But think about it, like 5 years ago or 10 years ago, no one was seeing such a video at all. So this is emerging very, very quickly. These robots make many mistakes, but that's just the beginning. And I'm pretty sure within 3 to 7 years, these robots will be a part of our life, not daily life at home, but certainly, and we already have that stage reached, in many factories building, cars, pipes, they're already in place. And the next big thing I really strongly believe in is the scientific breakthroughs. It will be able, with AI help, to find new medicine in a much shorter time. And therefore, it is probably much cheaper to develop and less failure. In return, that should help to boost the margins from biologic companies, pharma companies, chemistry, etc., etc., etc. And within 10 or 15 years, we talk about superintelligence, AI superprocess, human learning. Yes, might be, but be aware of it. Like whether it's going to be 10 years or 15 years, it's really hard to judge. But behind all these developments is a chip and a data center. And with that, I'm more than happy to move to the next slide. So to give you a rough understanding how it developed over the last 10, 15 years to reach 100 million weekly users. I want to focus here on the right-hand side on this black box. It took Google 72 months to reach 100 million weekly users. Now, ChatGPT, it only took 2 months to reach 100 million weekly users. That gives you an idea how fast this technology is evolving. Even if you look at Gemini, it took them 12 months. So that's so much less time to need to reach to a broad audience. And even I do use Gemini 3.0. And yes, I'm willing to pay for it. So now I always hear these companies don't make money with their AI models or with their large language models. I tend to disagree. Of course, for the moment, they spend a lot of money for CapEx, but once we are in that system, there's almost no way to get out again. And I really believe the pricing power at the end of the day lies at Google and ChatGPT and probably Microsoft and whatsoever. So it gives you a rough idea how strongly these things are emerging now. Next slide, please. All right, now the AI ecosystem is crucial to understand. In the middle, you have the hyperscalers, so they're building factories for the future. Now think about back in the year 2000, we had so many US companies laying their fiber cables through the Atlantic from Europe to US. Almost every company who was building that fiber cables below the Atlantic Ocean, they went bust. But what it basically means is when they laid these cables, that was the reason, and that is why we are now having the internet, just thanks to that technology they did 20 or 25 years ago. And maybe we are now entering the same thing. We're building hyperscalers like mad, laying the foundation for future work. And on the left-hand side, you see the AI models, you see semiconductors, and you see power supply. So it all starts with, from the bottom, power supply, semiconductors, and then the AI models. And on the right-hand side, you see the applications where it is needed. As I said, pharma, your daily work, and also, of course, autonomous driving, just to name a few of all these potential use cases. Next slide, please, Michael. Thank you for that. So, okay, in the middle, you see the hyperscalers. If you focus on the middle, on the left-hand side, you see the US companies, and on the right-hand side, you see the Chinese companies, starting with Alibaba, Baidu, Tencent. And for the US case, it's Amazon, Microsoft, Google. You all know the names. On the top left, AI models, highlighted with yellow, ChatGPT, Copilot, Gemini. These are AI models. Now, the other ones, Mistral and Albertus, are basically European names, while the red ones are the Chinese AI models, best known with DeepSeek, for instance. Then we have the semiconductors, so the Halbleiter. That's NVIDIA, AMD, Broadcom, Intel, Cerebras. So you all know the names, but you also have Micron, Samsung, etc. That's for US and Europe. And you have Huawei, Capricorn, and Hydron in China. Not so well-known names, frankly speaking. And of course, it is all only possible thanks to a massive power supply, Constellation Energy, or VW, RWE in Germany, etc., etc., etc. And the applications for all of them you see on the right-hand side. These technology, in combination with supply, semiconductors, and AI models, is helpful for Palantir, Siemens, industrial AI, productivity, for instance, Microsoft 365 Office, consumer AI, Google, Perplexity, healthcare, I just mentioned, enterprise marketing, yes, of course, Salesforce Meta. They use a massive amount of data to analyze how people do spend and how much they spend, at what time of the day they spend, etc. Mobility, Tesla, of course, and security. That's a big thing going forward. I really believe in cybersecurity and defense for the next 10 to 15 years. Because it just started this whole hacker stuff, and therefore Palo Alto, CrowdStrike, and Cloudflare. Maybe we can move on. All right, AI hyperscaler investments at a very large scale. So global installed data center capacity was last year 122 gigawatt. That is equal to 122 nuclear power plants, basically. The top 5 hyperscalers operate 486 data centers, and 288 are already planned or under construction. So that's a massive growth there. So on the right-hand side, I don't know whether you can see that the biggest hyperscalers are Amazon, Alphabet, Microsoft, Meta, and Oracle. Although I wouldn't bet really on Oracle. This is one of these big assumptions in my view. I strongly believe when it comes to AI, the winner takes it all. And I'm not sure whether Oracle is going to be one of these the winner takes it all names. But that gives you a rough idea how much these companies are pouring in to be able to operate data center, because the need for computing power is going through the roof. And that was exactly the same pitch 5 years ago, and it proved to be right. And I doubt this will sooner or later be no longer the case. Thank you for that. So here you see the Stargate project. And if you compare that to a football field, if you look at the right-hand side of this little crossroad, that's probably the size of like a football game. That gives you a rough idea how huge these data centers are. Now we talk here about Stargate project. The total investments are 500 billion. That's a rough guess. It is joint venture between OpenAI, SoftBank, Oracle, and GX. We talk about 10 gigawatt, and that equals 7 nuclear power plants. Just to highlight how fast and how important these data centers build up is to be able to lay the foundation for the new way of working for the next probably 10 to 20 years. Thank you for that. All right, and that's the slide that I think I showed it also 5 years ago, and nothing has changed. There is still a huge misunderstanding who is doing what. I still have a lot of incoming questions. Ooh, Apple is building a new chip. It is not the case. So you have here in blue the designer of a chip. And most prominent name is NVIDIA, of course. They do design the chip. They do not build it. And the same is true for Broadcom, AMD, Apple, etc. They simply design a chip. Now, when the chip is finishly designed, they go to Taiwan Semiconductor with their plans and say, here we are, can you please build the chip for us? So that's where Taiwan Semiconductor, Samsung, also Global Foundries come into place. They build the chip for the designer of the chip. Now, let's go to the right-hand side, the subsystem suppliers and the equipment suppliers. Before Taiwan Semiconductor can build a chip for NVIDIA, they have to buy the equipment to be able to build a chip. And the equipment is done by ASML, you know the story, but also Applied Materials, Lam Research, KLA, Tencor. They all have different kind of systems, like monitoring the services, monitoring the whole factory. ASML is this ultra-high violet story. And on the right-hand side, you see the subsystems supplies. And these companies, VAT, Comet, Inficon, Swiss names, and then with Zeiss, Canon, etc., they are absolutely mission critical. If these subsystem suppliers decide to go on holiday for 3 months, you will not be able to sell any chip on that world. And then we have also the integrated service makers. They do kind of own equipment. They do, but also rely on equipment and sub-suppliers. And Intel is probably one of the only one designing a chip and building the chip. So, but in theory, basically, you have a designer, you have a foundry, you have the equipment maker, and you have the subsystem sub-suppliers, which are mission critical. That's how this chip supply chain looks like. And also here, the winner takes it all. Think about VAT as a subsystem supplier. They have 70% of their free cash flow goes into research and development. That is almost 100% more than the next possible competitor. So that's for me also a typical the winner takes it all. On the other hand, the subsystem suppliers, they are very cyclical the companies when it comes to sales or order backlog, not order backlog, but sales and new orders. Typically, they have like a lead of 1 to 2 months, maybe 3 months. The thing is, when NVIDIA designs a new chip and goes to Taiwan Semiconductor asking them to build a new chip, either do it with the existing plant, or they say, oh, wait a minute, this is a technology shift, so an upshift. If that's the case, they have to go to ASML, and ASML has to go to VAT. And our analyst strongly believes, but also VAT, Comet, and Inficon told us they are ready for the next up move in the new generation of chip. So it's not a question if they get these orders on board, it's a question when. And we're waiting for it. But if I listen to these guys, 2026 should be like the year where these new technologies will come in place and new systems and equipment need to be delivered to Taiwan Semiconductors. Next one, please. So the impact on the global semiconductor industry, that's important to understand. That's the aggregate revenues of the 14 leading chip vendors by main application. So most of the chips now are going into AI. When we started back in 2020 or 2022, that was not the case. And then suddenly we had OpenAI really open up the race. And the black ball was just keep on growing. But also the memory is, of course, growing. Whenever you have a computation, that's one thing, but that needs to be stored somewhere. And that's where the memory chips comes in place. They're much cheaper than the AI chips, of course, but they are essential to store the data. So that's important to keep in mind. Also important to know is looking back at 2022 when OpenAI kicked off ChatGPT. At that time, Google was also ready, but they didn't want to be the first mover, but they were already ready with their own large language model. So they were basically waiting for someone to open the bottle. And once this happened, thanks to ChatGPT, of course, Google was then following. So the race is on, and that will just keep on going. Thanks for that. Aggregated revenues of the 14 leading chip vendors. So as you can see, NVIDIA was emerging from being a nobody to the winner takes it all. Now, what we could see in the last couple of, I would say, quarters, AMD is starting to be eating or grabbing a part of the cake from NVIDIA. And that makes perfectly sense because if you are totally reliable on an NVIDIA chip or the NVIDIA ecosystem, you probably end up being too dependent on one single supply. So that's the reason why AMD is now emerging also, and also Broadcom is getting a bit of that cake. But NVIDIA is really leading the technologies still. It is said to be 1 to 2 years ahead of the next competitor. And in that case, the next competitor would be AMD. So if that's really true that they're 1 to 2 years ahead of the curve, well, again, here, the winner takes it all. Thanks for that. Combined annual growth from now till 2027 in revenues in US dollars is seen to be 12%. But we are talking here about semiconductor equipment makers, as just said before, ASML, Applied Materials, Lam Research. Also here, the winner takes it all, ASML. Without ASML, no chip. Without Applied Material, no chip. So that is basically the driver behind it. And this is an extremely, I don't know how in English, filigrane supply chain. When anything should potentially go wrong, I think the world has a problem. So it is important to understand that these supply chains are extremely filigrane and need to be taken care of. And that's also a reason why it is important now question mark in between that. Taiwan should be taken very much care of because most of the chips on this planet are done at Taiwan. And we all know there is a big push going from east back to west to onshore basically the chip production more to the Western world, so saying Europe and of course US. That race is now going on. And that's also a reason why US tries to exclude China from being able to buy the NVIDIA high-end chip, so-called cutting-edge chips, but also from AMD, etc. The flip side of that blockage is if you block a country like China, you also lose the control where they stand. And it looks like that China has really geared up a lot and they have excellent chips made in the last couple of years. So the race is getting closer and closer. But in the lead for the moment is still, of course, the NVIDIA, the US chip makers. Next one, please.
Maybe, Daniel, if I can, in between very quickly.
Sure.
Given that you're speaking about China, US, and how they develop AI and take that further, you don't see a change, the two blocks, if you will, they will continue to work on the same topic, but they would apply their own standards and their own strategies to developing the industry, right?
Yeah, correct. So we probably have built two blocks. One is, of course, China, and the other one is the US. US was really leading for the last, well, probably would say 25 years, but in the last 2 to 3 years, China has really emerged. And unfortunately, that was the mistake from the US to cut off Chinese tech companies to use US-produced chips. As I said, if you cut off someone, you probably lose also control. And that was, looking back, probably a mistake. But at the moment, well, the knowledge is still in the US to build technology. And here comes Trump again. If Trump really believes he wants to block Indians and Chinese, extremely well-educated people working in the US, that's a problem and could become a decent problem going forward, because if these highly educated people decide to stay in China and they get evenly well paid in China, that could be really a problem for the US tech industry going forward. But I'm sure if I think like this, the US probably think the same way. Does that answer your question, Mark?
Yeah, thank you.
Cool. I'm not such a big fan, to be honest, from that slide, but what I think is really important is Jeff Bezos' sentence on the top end. Financial bubbles destroy everything, but industrial bubbles create the future. I fully agree. As I said at the very beginning, when we were laying these fiber cables below the Atlantic, that was laying the ground for where we are now. And I'm pretty sure this data center is kind of the same thing. And yes, of course, if you look at that slide here in channel from a distance, it's all about circularity financing. I'm not a big fan of that. Also at my end, that rings a bell, and I get a bit more cautious, to be honest. But I think it's not yet a big problem, but it's something we need to have a closer look going forward. Also, when I see the Oracle CDS going through the roof, and again here the winner takes it all. So the market is now entering a phase where they look very close to announced deals, and especially these announced billions. When I was talking to my analyst 2 days ago, asking how to look at these hundreds of billion deals, it's important to understand that is just like a number they put up. That doesn't mean that the money is already flowing. They can easily say, let's take NVIDIA invests 100 billion into OpenAI. They could easily say in 2 months' time, NVIDIA says, it's no longer 100 billion, it's probably like 50 billion. So this risk, of course, is here. And if someone in the future, these kind of statements will hit the news tapes, then the market will probably go into a correction. As I said before, this is still a very cyclical business, unfortunately, but that's certainly a risk, yes. Thank you. Now, talking about valuation and bubble. if you look at the left-hand side, Cisco, March 1996 and until March 2000, Cisco was going through the roof when it comes to 1 year forward PE. That's absolutely not the case for NVIDIA today. Of course, NVIDIA is not cheap, but defined cheap. So NVIDIA trades at roughly a 40 PE. But having such strong growth rates, I think it's probably justified. And more important, or equally important, is the right-hand side. CapEx is financed from cash flows rather than debt. Of course, Oracle is a different story, but the Mac 5 or even the Mac 7 are able to finance their CapEx through their regular free cash flows. And that's important to know. I have seen the chart just the other day. These Mac 7s are now going to I wouldn't be net debt saying very soon, but of course, when you spend so much money, your net cash is shrinking, of course. But for the moment, they're able to stem it via their free cash flows. And that's a big, big difference compared to the year 2000 when everything went down the drain. That's a big difference. Yes, valuations are elevated, but they're consistent with previous average levels. And now they are based on solid earnings, solid cash flows, and solid balance sheets. The exception still is Oracle. AMD, that's the light blue one. That looks a bit odd, to be honest. So that's probably something you need to think twice before you step in there. But if you look at NVIDIA, or especially Google, that's the yellow one. I'm absolutely happy paying for Google a PE of 20 and also for Meta. Why should that be wrong? Because we are now in the middle of an industrial revolution. I strongly believe also here, Google is the winner takes it all. They just designed a new chip, which is way above, more intelligent, apparently to themselves, versus an AMD NVIDIA chip. Whether this is true or not remains to be seen, but they have a different approach how they build now their own chips, or design their own chips, excuse me. So he gives you a rough idea how valuation looks like 1 year forward PE. So that doesn't look very expensive to me. The energy problem, and this is a problem, and that's also the reason why these, I call them lunatics, start to talk about building chips on the moon or in the space. But you have to know that if you want to have a computer power of 1 gigawatt, which equals 1 nuclear plant, you have to shoot 10,000 satellites to the orbit to be able to build that. So in my opinion, that's years away, but at the moment, I really try to focus what's happening down on Earth here. So on the left-hand side, on the left corner, on the bottom, you see global data center electricity consumption since 2020 until 2035. The orange dotted line is really like the blue sky lift off. Blue is the base case, and the headwind is was a brown or red, call it. But in any case, the electricity consumption is going higher. We talk about 1,220 terawatts in 10 years. That's massive, massive. So on the upper hand, right, data center in operation in the US at the moment, they are consuming 55% of the global capacity. I mean, it's amazing. The total consumption back a year ago was 415 terawatt. That's 7 times what Switzerland consumes. Gives you an idea. We talk about decent numbers. One large data center, I just said, is 1 gigawatt, and that equals 1 nuclear plant. That's why it's so crucial to have a properly going energy supply, be it renewables, be it, for instance, gas. It could even be coal, unfortunately. But fact is, by being able to implement AI, and I will show that just in a minute. You see here natural gas is 3.8 million tons of CO2 emission on a year. Coal only emission 9.2, and the Swiss mix, as always, is very, very low. It goes below 5 million tons per year. So the typical emission of an average US data center per gigawatt is 2 million CO2 tons. That's massive. And on the next slide, I try to highlight how this looks like or what the plans are from these big hyperscalers. And let's focus on the right-hand side, please, where this orange or this red circle is. Meta, for instance, they have 100% renewables since 2020. So basically, they are emission-free. The same is true for Google, and the same is true for Amazon, but also for Microsoft. On the other hand, there is an obstacle now because the growth and the demand for data center is so strong, the current share probably will fall below 100 again, because the need of energy is so high, they probably need to also have gas as a potential source of energy. So yeah, you can like that or not, but for the moment, these companies are really on renewable electricity, that they reach their targets. It might fall below 100% in the next years. Fact is, and that's now an excellent use case by using AI, and we looked at the US use case freight logistics. 7 to 8% of global CO2 emissions are done by the freight logistic of this world. AI now can help to reduce the emission by 10 to 15%. Why is that? Because using AI, they know with much more granularity where they need to send their ships to be efficient, to deliver goods from China to the US. That includes tides, winds, temperature, anything you can think about it. So that makes these ships much more efficient when it comes to sailing from A to B. And therefore, 1% of global emission can be reduced. I think that is good news. So it's not everything bad by using so much energy, consuming so much energy. Once the data is being properly and cleverly used, there is an impact for lower CO2 emissions. And I think that's the good news behind it. We can move to the next one, Mark. Delivering productivity gains and enabling new business models. I don't go into details with that, so you're more than happy to read that in a quiet minute. I'm just highlighting here again who is doing what and who might be benefiting as of now and in the future. Drivers, how much value can create AI? So drivers of an economy is always the same. It's population growth, so basically labor force, it's capital, and it's productivity and technology. Now, AI, as I said at the very beginning, agentic AI, I'm happy to have sitting one next to me for free. So artificial labor force, data center infrastructure, and productivity boost, enhancing humans' workload. Impact on global GDP, that's massive. That's on the right-hand side. Global GDP in 24 was 110 trillion. Generative AI could boost GDP by 2 to 4%, according to McKinsey, but that's a 2-year-old number. AI software and service could add also between 15 to 23 trillion by 2014, but that's only 15 years ago. And so on, and so on, and so on. So the productivity gain from AI could be far bigger than from PC and the internet. That's important to understand. That's an industrial revolution that takes place now. And that's also important to know. There is always usually a 5-time lag when we have a new technology in place. Usually after 5 years, productivity starts to improve, and that's going to be no different this time. I have a better chart here, but it's not on this slide, unfortunately, but the message is the same. It's usually taking 5 years until productivity beefs up. We're just waiting for that. And that's the case then when people start to think, oh, wait a minute, finally these CapEx are paying out. And it's just a question of time. From general purpose to accelerated computing. So here are a couple of sentences from Jensen Huang, the CEO of NVIDIA. You know, have a look, read that, and think about what this Huang is really building. They are building like an ecosystem. It's the same thing like being an iPhone freak. Once you have an iPhone, you probably almost can't get out of iPhone anymore because it's like an own economic system. Same is true for Google Pixel, for instance. So once you're in, you're caught. And once they know you're caught, they will charge you. And it's a pretty simple model, actually, but I like it. So here are the key messages. Yes, we are still at the beginning of the AI journey. We said that 5 years ago, and we are unfortunately still at the beginning. Unprecedented changes imply significant uncertainty and risk. That's important to understand. If they start to cut the capex for whatever reason, the market will go into a correction for sure. We can see already now below the surface, loss-making AI companies are falling off the cliff. So at the moment, we are going to a bit of a rougher time. A bubble is very possible, but AI is a real and fundamental supportive. There will be bumps, as said many times here, power supply, capacity utilization, economics, that all will have an impact, of course. Expect substantial volatility given the unprecedented opportunity, and it's all new for us, so no one went through this before. Valuation creation potential is large, but companies will need to adjust business model. And as I said at the very, very beginning, these cycles get steeper but shorter, but I'm sure that these companies can handle it. But again, I'm a big believer the winner takes it all. And with that, I think I'm at the end, despite the legal disclaimer.
Thank you so much, Daniel. Greatly appreciated. You know, I have one question from basically looking at the cycle. Are we at risk that we underestimate the speed of the cycle and the adoption rates? It feels to me like we've always sort of felt it's we're somehow behind, and AI has always sort of outdone our our predictions. How do you see that?
Well, I think it's probably common understood on this planet. On the short time, we overestimate new technology. On the long term, we definitely underestimate. So to answer your questions, I think we underestimate what is happening right now. But that has nothing to do with where the stocks are trading. I mean, there are two worlds. One is the financial market, the other one is the industry that they are now building up. So I really believe we underestimate what's hitting our world in the coming decades. Maybe we do underestimate the valuation for the moment. So it is a bit bumpier. I agree. And what we can see in the last couple of days, and I brought that with me as well. I read a decent article from Goldman Sachs the other day. What we see below the surface is there is a rotation going on out of these overvalued or highly valued tech names into healthcare, financials, utilities, and basically defensive stocks. So that takes a few quarters until these concentrated holdings are again back to normal levels.
Fantastic. Thanks so much, Daniel. Dear guests, I hope this was insightful. If you have additional questions, please use the chat function now. And then let me advance this because we've running out of time or overrun already. Before we close, let me allow you to thank Daniel Bläsi of Bank Vontobel, Marcel Schnieder of Alternative Partners, and our Adrian Kirigin for sharing their insights today. Dear audience, from me and my colleagues of Probus Pleion, thank you for joining the call today. We greatly appreciate your presence. Then we'd like to thank all my colleagues in the background that work hard to make these webinars as smooth and successful as possible. Thank you guys. It's amazing what you do for us. The next quarterly outlook will take place on March 26th. So please pencil in March 26th already, and we'll keep you posted. Then again, thank you for dialing in today. We're deeply grateful for those of you who are already our partners, and we thank you for your trust in business. We're looking forward to further strengthen our ties with you. For those of you who are contemplating joining us, we appreciate your consideration and the time you spend in order to get to know us better. Thank you all for being with us today. We're looking forward to the next opportunity to see you in person. We wish you and your loved ones a happy holiday season and the very best in the new year. Probus Pleion Group, large enough to matter, small enough to care. Goodbye.